or is the trend slowing down? And then say, all right, under these market conditions, this is how I would like to behave. This is the tactics that I'm going to use. Okay? All right, well, let's get going. It is it Friday yet? Oh, hey, look, it's Tuesday, March 24th, 2015. This is your daily Forex trading session. My name is Wayne McDonald. I'm Chief FX Market Strategist for TradersWay.com. Thank you for being a client. So what do you want to cover today? Go through the basics, go through go through the binaries, or I should say the commodities, intermarket stuff, then tiptoe right into currencies. Yeah, Mike, I'm going to make one more comment, then I got to move on with this. Mike, I've never asked you to identify a trend. You're not capable. I've asked you to flip a coin, identify support, fear and buy. Right now, we're only trying to get you to control your behavior. I don't care what direction you pick, because I haven't given you that capability. We're not working on that, so who cares? I know. Yeah, I know what you're saying. Good. Well, stop saying negative stuff. Check your negativity at the door. Right? So the only thing I want to hear is, my name is Mike. And I wake up in the morning, I flip a coin, and if it says bull, I identify levels of support which I would like to buy. That's it. Every day for 5 weeks until it's habitual. But this is a tough game, Mike. We're all in it together. We're all working on different things. It's a tough gig, and you know what? I've been doing it a long time, and I still, still strive to improve. And that's the name of the game. Let's get going, huh? At least you're with the team now, Mike. We'll take care of you, buddy. No, I'm not asking you to be quiet. I'm just asking you to stop saying things like, I can't do this, and I'm... Nobody cares. I'm not going to reinforce negative comments. It's not going to do you any good, right? Anyways, hey guys, this is a tough gig. Trading and investing is risky with leverage. It's not necessarily appropriate for you or your neighbor or your neighbor's cousin down the street. You could lose money. It's easy to lose money. Therefore, never risk money you cannot afford to lose. I've always said that the key to success, amongst other things, is staying small in your ambitions, focusing on the day, not risking money you cannot afford to lose. Remember, the way to get rich in Forex is slow and steady, steady and slow, and it's through compound interest, not an increase in leverage and degenerate gambling. I had a guy the other day tell me how good a trader was, that I was a pathetic trader, and that because he, triples his account every 3 months. Like literally, he says he's doubling his account a couple of times a month, and that makes him a superior trader. I think it makes him an idiot. But the difference is opinion and leverage. You know what? That's too much leverage, my friend. Yes. So I wish him the best of luck. I hope he keeps that up. That's amazing. 1 point here. What is the average return for a professional foreign currency trader? Like you're a hedge fund, you got let's say at least 100 million bucks. What are you making on average per month? I just want to put it into perspective. Yeah, about 2% a month. And that's if you're above average. 1 to 2% per month. If you're above average, if you're good. And that's not every month, obviously. You're going to have months where you're down. You could have 3, 4, 5 months when you've lost 1 or 2%. Well, but you don't want to do that too much. But thinking about it, if you're bringing home 20 or 30%, let's say, in a month, or losing 20 or 30% in a month, you are trading with 10 times the amount of leverage that a professional is. Okay? And obviously, that brings additional risk, because reward is a function of risk. So if you're trying to double your money every year, what you're trying to do is about 5 or 6% a month. Now, because you're undercapitalized, that's again within reason. Now you're double, maybe only triple the leverage of a professional, but you got to make money, right? And you're undercapitalized, so you got to sort of make it up somewhere else. But as long as you're growing your trade account, if you put more in your trade account and take less out to pay yourself, then let it grow. Then over time, what you can do is reduce that leverage and get it back to a normal rate. But if you're trying to double your money every month, you're doing that through, leverage. And then, of course, usually the person that shows me that they're trying to double their account every month, I say, well, how many pips do you make? And they're like, well, I made 190 pips last month. And it's laughable. Really? You're trying to double your account with 200 pips? It's redonkulously ridiculous. Lower your leverage, guys. Make it a long-term game. When I work with people one-on-one, with traders, the very first thing I do is I get them to 1,000 pips a month. And they just can't fathom it when we start. And then they're ashamed when they don't do it just a few months later, because we've changed the mindset. It's just a switch in the mindset. Sounds ridiculous. And yet, just after a while, people realize, see, how about this? And then, I don't know how I get on these tangents. The tough part of trading is analyzing the market, making a decision, identifying an area of which you'd like to enter a trade, and then once you've entered it, which in of itself can take a lot of time and energy, but once you got it, the trade in, you put a stop, everything's set, right? Right? How much work is it now? So if you have a half reasonable trade, and this is why, like with Mike, we're working on very basic things. Support, sell at resistance. We're not even working on the decision-making process, but it's key. If you buy at support and the market is bullish, how wrong you be? It's almost impossible to be wrong in that scenario. So what does an amateur trader do? They don't realize they're in a trend. They don't realize they bought a key support. They'll buy at a massive support area and take 12 pips profit, or 25 pips, or 50 pips. You're like, yeah, you made 50 pips. What? 50 pips? Right? Like when the Euro USD dropped 4,000 pips, and you're like, yeah, but I made 50 pips here, 50 pips there. And then for the third Tuesday, I made 33 pips. I'm like, really? Dude, seriously. You could have just let it run. And that's what we can find very often through a process of scientific methodology, measuring your trades and creating a valuation for your average trade. We can find that the hard work is entering at support in a bull market, or entering at resistance in a bear market, and waiting for the timing of that. That's hard work. Once you enter it, it takes very little effort to just let it keep being profitable. And then finding another trade, adding that trade. Most people right now, they're trading successful, but they're unprofitable. And what I mean by that is, you're doing everything right, and then you screw it up at the end and make sure you're not profitable. You don't do it, consciously. But what a typical amateur trader, especially one that's been trading for a year or two, they're so nervous about not losing money, right? You're not even trying to make big money. You're just so worried now of losing money because that's how it starts. In the beginning, you just lose money like crazy. So now you don't quite trust yourself and you're so worried about losing. So what happens is you basically cut all your winners. Because usually what happens is, let's say your first trade of the day, you lose 33 pips. You're just too eager or whatever, right? Then your second trade, you're up 33 pips and you're like, man, if I take this now, I'm back at break even. So you cut the winner. But that could have been worth 300 pips, right? So it takes a while. It's a tough gig, man, mentally. But that's why you got to look at your trading intensely. And that's how you build up confidence too, right? Not just through consistency, but through the measurement of your trading so that you truly understand your strengths and weaknesses and your focus is in the right place. And therefore, because you understand, you can have a true confidence. Justin, do I offer one-on-one trading? Generally not. I'm a pretty busy dude, but sometimes, sometimes. But that's not why I'm here. I'm not. So, anyways, that's not why I'm here, buddy. So, as long as I'm here, I'm willing to. So, anyways, let's go into the technical analysis. I'm sorry for that if it was too off topic. Okay. You see this old resistance zone? Look what happened to it in the future. Interesting. Did this one work out? Not quite the same. Well, maybe a little bit, right? So now where are we here? What is this, USD yen? Yeah. Oh, by the way, I was talking to somebody yesterday, and he said he took this trade, this USD yen trade at 120, and used a binary to hedge it. Lost money in the cash, made profit on the binary. Yeah. Now didn't make money, but cut his losses almost in half, just like they described. Awesome. That's what I like to hear. That's, when you think about, a retail Forex trader doing that now, identifying trends, thinking about fundamentals, taking in key psychological levels and pivot points, and then entering a trade and saying, I like this, but it's still technically bearish even though I'm a bull, so now I'm going to hedge using a derivative and cut my risk in half. Like, wow, it's amazing. Great job, right? 1, 2, you rock. Boy, we've come a long way, huh? That's really awesome. I like hearing that kind of feedback from you guys. So what do you think of these areas here? Does that look like support? Now, I believe we talked about this yesterday. My eyes are on the 119 and 118 levels, right? Does that sound right? Remember, if you don't remember it that way, then it didn't happen, no matter what happened. Yep. So there's a buck 18. Here's a buck 19, right? And here we are at 30, which is fine if you look left with me, right? We'll look left with me, right? If you look left with me, you'll see that this was a support area. Is it a psych level? No. Is it a pivot? That's a daily S2, not a weekly. There's a lot going on a little bit lower. Daily S3, psychological level, weekly S1, and a fib of the drop, or the fib of the rise, I should say. So it's interesting. Now, my fear, if you will, I know it's hard to see with all those pivots. Maybe I'll clean this up for you. Hang on. But what pattern do you see here, guys? What do you see? Let me get my drawing tool out. Beep, 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 beep. All right. Here's my concern. That didn't draw. There we go. We come up, we come down, we come up, and here. Now, of course, our low is only here, but the top bothers me a lot. That bothers me a lot. So I wanted to make a higher high. I have serious concerns about this right now. And what you want to see if you're using Fibonacci, let's say, and you want it to go up, what you're hoping it does is come down. Let's say this is about a 618, right? I'm just eyeballing it. Weekly S2 is at a 618. That is the maximum I want this to fall as a bull. If it goes any lower than that, I have to change and adapt. Okay, so we're talking about analyzing market conditions before we started the session today. And that's what I'm doing here. I'm nervous already about the way this is going, because if this was so bullish, why didn't we make a higher high? Hey, I thought it was an uptrend, right? That's okay. So I'm already shields up, red alert kind of stuff. And I'm not going to freak out until we kind of get to this area, but anything lower than a 618 is, oh boy. So I will go, I'll bug out. So that's what I have my eyes on now. I still want to buy 19. I still want to buy 8 if we get down there, but I think it's a hope and a prayer at that point. I'm just trying to maybe be part of the catalyst that if it reversed it back up, it does reverse it back up, but I'm not that hopeful. So we'll see. So maybe this is just the last of the repatriation, and then we hit April 1st. But I've never really seen Japanese repatriation happen that way. It's not necessarily an event like this is the event when time is moving, right? That you hit and all of a sudden Japanese repatriation, right? It doesn't work that way. It's a slow. It's over a lot of time, over 3 months, let's say. So I don't know. Okay, so I'm being cautious. I'm being ready to run if I have to. But just focused instead of freaking out, focused, right? But I think the big difference of buying it at 120 and it takes off, actually 120 was a little higher, right? I think there's a big difference between we had to move, retrace back to 120, and then took off. Okay, I look at that, I'm like, okay, I'm aggressive. Well, now we're at like 1950. What's the big deal, right? The big deal is we didn't do the obvious. It was very, very bullish. It was supposed to bounce at 120 and put us at 125. And yet it didn't. I think when I bought it at 120, I think I was up about 100 pips. And then it's now, out, that trade's dead. Now we're here. It wasn't supposed to be that way. Okay. So I got my eyes on the prize there. And that's going to carry out to a lot of yens. Now, a few people requested I cover pound yen, so I will. My concern with that is the pound is weak and the yen is weak. So why are you guys focused on pound yen? Okay, just be careful. So let's analyze this quickly. This is a daily chart. Okay. So if you were a bull, it has to go up here. Why? Why does it have to go up here if you're a bull? By the way, if you don't know, type in a question mark and let me know where the gaps in knowledge are so that I can share. I mean, it's the reason I'm here, right? Because we're at a 786. If it falls any farther than that, it's not a retracement, it's a reversal. It has to go up if you're a bull. If it doesn't go up here, it ain't going to go up. So what you should be planning on is, a double bottom here. You have the oscillator, that's fine. You have a 786 support, fine. Can you let this go down to 7700? No, it's too far down. So it's not the world's greatest setup, but you don't have any other choice if you're a bull. Okay, so you would trade this on a smaller time frame as being a little more rangy. Okay, here's the zone. You got your hourly oscillator. It's pointing up, which is fine, which is good. Doesn't necessarily put you in a trade. But you can say you're kind of in this area between, basically you want to buy around 77.50 or 78. Oh, well, that's where you are now. The hourly oscillator gives you permission not to trade, but to consider it. Drop into a 15-minute. 15-minute gives you permission to consider it. Again, it's not putting you into a trade. But what the 15-minute chart is telling me is up, down, and then if you're right, up. And this makes me think of the hourly chart wanting to head up. So 15, so this can go up for 2 hours, down for an hour and a half, and up for the rest of the day, right? The reason I say this area is this 21 and this roll reversal. Okay, so that gives you permission for a long at 78. So now you drop into a 5, and you already got your 5A cross. You've already entered the trade zone. Your stop would be here. Your entry would be sort of in here. So you would have longed around 78. But here's the thing. This could go up, and you could take, you take your 15 pips, right? You could sell here and hope it breaks to the downside and the prevailing trend continues, and it's not a retracement, it's a reversal, right? Or because you have a 5-minute setup, a 15-minute setup, and an hourly setup, you simply long, keep your stop here, comes down, makes a new higher high. So now you move up to break even. And your limit is plus, I don't know, make up a number. More than you can imagine. 150 pips. Okay? And see if you can hit it. Why? Hope? Phooey on your hope. Bah humbug, right? Hope? No. Because you have a medium-term time frame. You have an hourly that says up. So let's go through this. If the 15-minute oscillator is trying to make a full cycle, I know this is a 5-minute chart, but the 15-minute looks just the same, right? So how long does it for a 15-minute chart typically make? How long does it typically take a 15-minute chart to make a full stochastic cycle? 2 hours. Okay? So how long do you think it would take an hourly chart to do the same thing? To make a full stochastic cycle from extremely overbought to extremely oversold to extremely overbought. Okay? And if it's in the direction of the trend, even longer, right? 6 hours on the short side, 12 hours on the long, on average 8. Okay? If this is at the beginning of the trading day, that would make it the vast majority of the trading day, right? So let's say you shorted pound yen at 2 hours before the London Open. And the trend had been down. Okay, so you shorted here, then London opens, probably does this, and then you find yourself 8 or 10 hours later with an average daily range, approximately, right? Now I want you to think of that. If you're selling pre-London, you should get the average daily range. Why would you pick up 20 pips in London? Doesn't even make sense to me, right? So that's why you look at things like average daily range. If pound yen typically moves 150 pips on an average day, and you sold at a top at the beginning of the London Open, shouldn't you try to at least get the vast majority of the average daily range since you picked the top? Yeah, Mike's fear of loss, like I said. You know, I actually dedicated a sub-chapter in my book to this topic, that amateurs are terribly afraid of losing money. Professional traders are terribly afraid of making money. Their worries at night have to do with how much money they have. They can't sleep at night because of the money. Not losing money, but how much they have, and what they tend to do is wake up in the bed in the middle of the night and cash out early because they have, they have so much. But the thing is, let's say if you got out of this 150 pip trade, well, what if it was worth 1,000 pips? And that sounds ridiculous to you, right? 1,000 pips in one trade? Hey, you haven't even tried. So what happens is it builds up, and what makes them make poor decisions is the emotion around how much money is floating there. But if you had, let's say, 100 trades open, and your stop loss is at break even, how many trades do you actually have open? None. Not really. You don't have any risk on the table. Not real risk. I mean, sure, the market could blow up and everything jumps your stops. But if you had 100 trades open and your stop is at break even on every trade, you have 100% available margin. It's the same as logging in and having no trade. But the problem is they're looking at floating profit and loss, right? If I get out now, I could have $1 million. Well, see, the market and the other market participants, they don't see your floating profit and loss. They don't have your personal goal, right? How many times have you got out of a trade simply because it was 100 pips? You waited. Has anyone done that? You're staring at it. 98 pips. Oh, I can't get out now. I can't get out at 98 pips. 99, I'm like, oh, almost there. 99 and a half. Oh, I'm going to get 100 pips. Oh, it comes back down to 98. And you're like, oh my gosh. And you're just sitting there like, why? The market doesn't care. The market doesn't see that. What's the big deal? You're inventing some weird emotion. But you know what? It's human because I've done it too. I swear I've seen it go to 99.50, 99 and a half pips, and then comes down 98, and then 96, 95. I'm like, oh man, I could have got out. Who cares? If you're trading other people's money, they don't care either. Yeah, the Visa has a great question on that one. Yeah. When you're in a trade, how do you not give back 75 pips if you're in a swing or something like that? DeBeasta, sometimes that's a consequence of your strategy. But this is why you should have multiple trades. So if you have a trade and you're up 100 pips, your stop's at least at break even, right? A bare minimum, right? Then go find another trade. Get that in. If you're a bull, buy at support, drop a stop, let it run. Once it's made a higher high, move your stop to break even, go find another trade. And buy that one at support. Once it makes a higher high, move your stop to break even. Sometimes they come back and knock you out, and all you got was 25 or 30 pips. Yeah, but you got 5 other trades going. And sometimes those go up, and they go up 300-400 pips. And it all works out, law of averages. But you have to ask, what kind of trading do you personally want to do, right? So if you're a scalper, you're constantly working at buy the support, sell at that resistance, and then buy again at that support. Meanwhile, there's lots of costs as far as there's commissions and spreads that you have to pay for every time. There's risks like potential slippage. And then, of course, the big part is you're staring at your screen, the full time. When you're a scalper, you're not just sitting in front of your charts, but you're actively trading, buying and selling and selling and buying, swinging both ways like a broken gate over and over and over again. It's very intensive. And a swing trader may come in to the chart, let's say pre-London, spends, 45 minutes to an hour going through the charts, identifying levels of support and resistance. Their point of view and their strategy is longer term, so they know if they're a bull or a bear before they even boot up their trading platform. So they're just like, okay, on the yens, I'm bearish, so I want to buy yen pairs, so I need support, and so then you go in and start analyzing those. Maybe you want to buy US dollars, so you already know if you're looking for support and resistance. So you must spend an hour or so doing all that. And then maybe use limit orders to get in, which is fine, or maybe you wait to pull the trigger. That's fine, but you spend maybe an hour or so a day, and you come back 12 hours later before going to bed, and you're like, how did I do? And sometimes the let's say the downside of that strategy is you can be up 100 pips and it comes all the way back, knocks you out of break even. Or sometimes, where you only get 25 because you moved your stop to pick 25, and but it shouldn't, the focus shouldn't be on one given trade, right? The focus should be on the averages. So for every trade that doesn't work out, I'm assuming though your entries are good, and it takes a while to qualify your entries. Are you buying? Are you trend trading in a range bound market? And there's all these concerns that you can have, but on the long run, if it's trending, because of the definition of a trend, if you're buying at support, it's much more likely to make a higher high than a higher low. So the vast majority of the time, it should work out where it might go up, let's say 25 or 100 pips, come back, make a 50% retracement, and then make a higher high again, and then you move your stop. But sometimes it doesn't trend. Maybe it's your entry on this particular trade is at near the end of the trend, and it makes a 786 Fibonacci retracement and knocks you out. But I don't know, it's just normal. But over the course of 100 trades or even 1,000 trades, eventually what will happen is some of your trades are going to be in the beginning of the trend, some are going to be in the middle, some are in the end, and they're all average out, and your average winner is going to be much bigger than your average loser, right? And your winning percentage is going to be higher. So let's say a typical place like I like to see a newer trader get is like at least 60% winners, right? And their winners are, I don't know, double the average size of their loser. You start adding those numbers up, if you have a reasonable sample size, now you have a career, right? But if all of this talk is about, your average winner is, 18 pips, like, dude, it's going to take you 1,000,000 years or 1,000 times greater trading account to get anywhere reasonable, right? So let's focus on getting you better trades that you can stay in longer, not ramping up the leverage, right? Better trades that you can stay in longer. And it's amazing because you're probably doing 90% of the work right now, but that last piece that you're missing is depriving you of 90% of your profits. And you're like, well, 90% of my profits. Well, yeah. If I can just, like, for example, if I did nothing but get your average winner from, 20 pips to 40 pips, and you do nothing more than just let your winners run, it's not any extra work. Luis says, is it fair that the market goes more than 100 pips because news reports? Yeah, but it's amazing. Like, there are some news reports that are surprising, but the market's so mature now that it's a pretty rare case. We usually talk about these news events before they happen, and then like it's almost a given, and then it happens. But the fundamentals are in play at all times, and the news events are almost blips, right? So they provide event-driven strategy opportunities. Like a CPI report coming out in 15 minutes, that's important. But, it's not crazy important right now because we know trend. What's important is central bank policy. Central banks, guys. Central banks. This is what you should learn to love. It's not today's CPI. That's an event. right? Non-farm payrolls, that's an event, okay? They provide volatility, fine. But it's really rare for you to be way off in your expectation of what's going to happen in the event. For example, non-farm payrolls. Look, this month, or sorry, next month, the month after, the month after, and the month after, jobs report out of the United States will be about 250,000. I'm done. Some of them are going to be higher, some might be lower. It's not going to be 350, and it's not going to be 150. Okay? Okay, if it was less than 150,000 in July, all right, we got something to talk about. If we start bringing in 350 to 400,000 jobs a month in June, all right, like something massive has happened. And that's going to force, if either of those things happen, it's going to force the Central Bank of the United States to make a change in policy. But more likely, we're going to stay on trend. And these, being, within 2 standard deviations, if one comes out 200D or the next one comes out 220, yeah, you'll get a little volatility and we'll be able to trade it. But the prevailing trends will likely continue. And these trends are actually created through manipulation by the central banks. So what we're looking at is for these longer term trends that I'm talking about is based on a divergence in central banking policy. Some are, most are in expansionary mode, right? Most are doing things to help support the growth and consumption with their own economy, to create like inflation in their economy. But some have already done that and are trying to normalize, which would be like the United States. So you have like the ECB doing an expansionary, and then the United States actually normalizing, they're going in 2 opposite directions. And these are the things that we need to be paying attention to. And today's CPI that comes out, it's the trend in CPI. And what we want to see is, the trend has been down, and then it's been moderate, and then it's been kind of up, and then it's been flat, and we're trying to get like this, but it just ain't happening. So it'll be important today. Maybe it'll create some volatility, but it's on the longer run, it's not likely. Today's CPI is not likely to change Janet Yellen and the entire Federal Open Market Committee's, policy. It takes these guys a long time to make a decision because they're looking at such complicated data. Okay? So CPI, nice little scalp, but on the long run, it shouldn't make you bullish or bearish on the dollar. It should already be set in place. And if you're a bull on the dollar and you're looking at Euro USD, good. Find 3 levels of resistance. And if price goes up there and you get a reversal pattern, take a shot, drop a stop, take a walk. And so what we're talking about now in today's market, let's go to that euro. What we're talking about now in today's market is there's still a high probability that if you sell at resistance, okay, here's our chart that we've been looking at for months now. If you sell at resistance as a bear for the euro dollar, there's a high probability it's not going to work out. Now, you might not lose money. You might even make a little money if you're still buying at key level or selling at key levels of resistance. In particular, on a 5-minute chart, if you're up at resistance and the 5-minute chart gives you a reversal pattern, okay, you'll probably still make you 20 pips or get knocked out at break even, and it goes the other way. So now what you're trying to do is maybe you take longer term trades here and jam us up at break even and let it break even. Who cares? Because the goal is to help turn the market around. And if that fails, maybe you take shorter term trades like scalps and spots to the upside, because we already talked about this 36 hours ago, that this is probably going to go up to the 200 EMA or to the 55 EMA on the daily. We've already discussed it. And that will probably sell this at at 111. Okay. But it doesn't mean you don't take the shot. No, I think you take the shot. Does it mean, you're come hell or high water, you stay short? No, 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 no. I want you to analyze and say, fundamentally, there, I want the market to do this, but technically it's not doing it. Okay. But does it mean you ignore it? No, because I'll tell you what. How would you feel about this trade if it did this? Yeah. So the question is, are you going to like participate in maybe having that happen up here? Or how about this? At least, at the very least, be sitting here waiting for that. But what does the 21 represent? This is where you buy, guys. If you're a So, you could do it like that. You could use binaries and kind of go both ways. You could be short-term long, but long-term short. So maybe you want it to make a lower high, lower low. But right now it hasn't happened. So you're just on the 15-minute chart, you're buying cycles until they fail. Okay, fine. I just want you to make a decision. So even if you're still buying it here, I think you can make 100 pips going long, even though I want it to go short. But the thing is, I want you to be ready so that when it does change direction, you're on the glue trade, right? Because what you don't want to do is sell here, sell here, sell here, sell here, sell here, sell here, and you keep losing money. And then what? You're like, okay, I'm going to start buying, and then you start buying these dips, and you buy here, and you buy here, and you buy here, and you're like, oh man, no matter what I do. Well, all you're looking at are these little moves. And it's just not enough. It's just not enough. It's just not enough. You're not looking at it from enough points of view. Okay. So I think it's key that we're at this 110 and failing. But I see this, and we did this weeks ago. This is the role reversal. It's more like 111. It's a 618, and it's a role reversal. Okay, and it's a 55 EMA. Okay. So be prepared. Is it going to reverse here? How would I know? But I want to be ready if it does. Okay. What do we do if it makes a higher high? Bull. Identify the next level of resistance and be ready there too. All you're doing is setting up ambushes, guys. Set up the ambush. How do you feel about selling this at 110? Well, if price hesitates, if price shows weakness, I'm going to fire for effect. But it blows through my defense zone here, just take a walk. Set up the ambush farther down the line, right? How about around 111? It's way up there. There it is. So if that fails, if it goes up, I can buy. I can keep buying now in a smaller time frame until it gets up here. And guess what? I'm going to set up an ambush there. Line and wait with booby traps, crossfire positions, dialed in with the mortars. And I'll just sit and wait. Any thoughts or comments, questions, concerns? This is tough, guys. It's hard being short-term long, but long-term short. But it's key, your behavior when the market isn't trending the way you want it to do, right? Let's say it's just moving sideways. You need to adjust. Or if you're a bear, but the market's going up for 2 days or 2 weeks, 2 months, sometimes it happens. You still need to be prepared to wait. Okay? Okay, and it's not waiting by not doing anything, but it's analyzing how you want to behave in these areas. So if this thing rolled here at 110, I'm going to be very happy to move my stop to break even when I can, and I might let this fall 3,000 pips. I know, I say it and you laugh and it's all funny. Ha 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 ha. But I've been talking about 80 on the Euro USD, not parity. I don't give two hoots about parity. I've been talking about 80. So I'm talking 3,000 pips. No joke. But that's what I said at 140, and I was crazy then. So anyways, yeah. Or it comes back and knocks me out of break even. Who cares? Because I've made 100 trades since then, right? I've just moved on. Like, who cares about the trade? My job is to identify resistance. Look, the psychological level of 110 is not complicated. 50% retracement. I think the fundamentals say down. Blah 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 blah. Take a half decent trade. Move my stop to break even, and get the heck out of the way. Go find another trade. Right? Then we get in that situation. Well, Wayne, what if you're up 100 pips? It comes back and knocks you out. Like, who cares? It's a penny. Right? My question is, why aren't you on 5 new trades? Why are you so obsessed about your one trade with 100 pips? Who cares about your 100 pips, right? Just find another trade. Take it as best you can with the least amount of risk as you can, and then when you're able, once it's moved along and proven yourself right, remove the risk by moving the stop. I prefer -1 pip. Some people prefer break even. Some people prefer +1. +1 because, I don't know, psychologically, it makes them feel good because their winning percentage is high. Winning percentages suck. Who cares? So I like -1, so at least I can measure in my statistics that it was a loser. Because break even is not a winner. +1 is not a winner. So I'd rather have the statistics to say, that was a loser. It didn't work out the way I wanted it to, right? And then let it run, go find another trade. So in my book, I reference this. There's a subchapter in the book, and I never really explain it, but it's titled "There Is No Spoon." And I was talking about this actually last night with another trader. Do you guys know the movie? The movie reference, "There Is No Spoon"? The Matrix. Thank you, Albert. Matrix. So Neo is visiting the Oracle to find out if he's the chosen one. He walks into the room and it's filled with brilliant children doing things like bending spoons with their mind. And he comes in and he's like, "Oh, I'm just an average guy." And he meets with the Oracle and he's got this, look on his face of amazement. And she says, "Yeah, you know what the most amazing thing is? There is no spoon." Because they're all in the Matrix. So you're right. In this case, once you got your stop at break even, right, that you have 100% available margin. There is no trade. It's not there. Stop worrying about it. Now your job is to, if you're a bull, find another currency pair you're bullish on, find support, wait for retracements to support, buy it when it's oversold, enter your stop so it's not too far away, you're not taking on too much risk. And when you're capable of doing it, remove the risk, go find another trade, because now that trade is gone. There is no trade. You have 100% available margin. Why can you not have 100 open positions? If your stop is on every trade is at break even, you have 100% available margin. Quit taking your little tiny profits. How many people here deserve to get paid? Right, so stop cutting yourself short. The hard work, guys, is making the decision. Right, Mike? The hard part is making the decision and carrying it out. Once you've done the hard work, you need to get paid. You need to let your winner run. Now, in scenarios like we are now, where you might be a bear, but the market is technically bullish, it's going to be challenging. Your patience will be tested. But you need to have resolve to wait and prepare and be ready, so that when we say, hey, this might fall here, good. But you decided that 3 days ago, 4 days ago. I think we did this last week. This maybe 2 weeks ago, this red zone. I mean, I'm telling you, this was way before FOMC. We already had this as a red zone. And a psychological of 110. That price of 110 has been there, since 1999. The price of 110. It's been there. It's psychological. We know also, based on the swing high, swing low, it's a 50%. Good. So you could be here, take a shot. What if you're up 40 pips profit and it comes back and knocks you out at break even? Well, two things. Who cares? You've already moved another trade. That one might. But what's the opportunity worth to you guys? $3,000 pips. Now, that is like, there's no scientific method to the 3,000 idea. Okay, why the target of 80? Well, I made that up. But what's the logic to get that guess? The ECB just started quantitative easing. The Fed has carried it out multiple times for years and now has ended that policy. And we are now in serious debate amongst market participants of when they're going to raise and how far they're going to raise it and how long that's going to take. But that could be years. We haven't even started the process of the Euro USD falling. Will we bounce at parity? I think something will happen at parity. So when we go in there, are we going to be foolish and just do nothing? No. I think we can guess reasonably that something's going to happen around parity. But to me, parity is nothing like you worrying about your 100 pips. I have 100 pips. Nobody cares about your 100 pips but you. Because no one else sees your entry, right? It's all just made up in your mind like a spoon, right? You're not bending the spoon. There is no spoon. Who cares about your 100 pips? But We can identify areas in the market where the market participants are likely to act. I think if you were short at 110 and this thing fell 1,000 pips, I think somebody in the market is going to want to take profit at parity because they're greedy or because they're fearful. I don't care either way. And I think somebody might even actually long it. Why? Because they sense the fear and the greed in those who are short. So something, almost for sure, 99% chance is going to happen at parity. I'll just be prepared. And then sell the rally when you can, just cautiously and patiently, without being silly, without taking undue risk, without degenerate gambling, right? Hey guys, thank you for being on my team. Thank you for being a Trader's Way client. I'll be here tomorrow, 7:30 in the morning, New York time. Will you be? Will you join me? My quest for Camelot. Cool. Cool. Then I'll see you tomorrow, eh? Remember, subscribe at YouTube so you can get the videos if you miss a day, or if you want to go back and listen to the same Babylon, feel free to do that. That is http www.youtube.com/c/Leaders Way. Take care of yourself. You hear?